Hey, it's Cody A here. If you're new to stock option investing, in this video, I will explain all the stock option terminology you need to know in order for you to start trading stock and option. I know the market has been a down market, but there is still a lot of opportunity, and this is the best time to learn. For all the new followers, my name is Cody Ye. I'm a 7-figure stock option and real estate investor. I've also been featured on TD Direct Investing webinar and also was featured on 70 plus investing podcast last year alone. So the first thing you need to know is called strike price. This is the major difference between stock investing and option investing. There's no such thing as strike price in stock investing. So what is a strike price? Stock price is the predetermined price where you sell or buy the underlying stocks at. Number 2, expiration date. Options do not last forever. So if you're an option buyer, you need to exercise your option before or on this day. If you're the option seller, you already got paid the premium up front. So you can either let it expire on expiration day and continue to keep the premium, or maybe you have the obligation to buy the stocks or get to sign away your stocks. And third is the premium. I kept talking about the premium. Premium is the money you get paid when you're selling this insurance contract. And if you look at the screen over here, before I go into the terminology, I will show you guys a screenshot that I took 2.5 years ago right on my phone with the Interactive Broker platform. Okay, so from there, we'll introduce everything and you know where everything is. So first thing first, when you look at the screenshot, at that time, Apple, ticker AAPL, right? The price is about 123.26 and that is the stop price, right? The number one thing I wanna introduce to you guys is the strike price. The strike price is the predetermined price where you can buy or sell the underlying stocks for. So in this case, right now the stock price is 123.26. We're looking at a strike price between 118.75 to 126. Okay, so these are the strike price. And number 2 is the expiration date. So options do not last forever, right? So for option buyers, you have to exercise your option on or before this date. Now, if the option seller, you already get paid the premium, which I get into next. You already get paid the premium, which is cash up front. From there, you basically just have to let your option expire so you can keep all the cash or equal to the premium. And in this case, the expiration that we're looking at is October 16, 2020, as you can see with the number 2 up top. Now, number 4 is the position. You don't see it on the screenshot because once you make the trade, you will see a positive one or a negative one on your position. When you're buying an option, whether you are buying a put option or buying a call option, it's gonna show up as a +1 on the position. Now, if you're selling an option, whether it's selling a put option or call option, it's gonna show up as a -1. And number 5 is called the last. This is the last price that this option has been traded at. So if you look at the screen here, right, that's for example, strike price of 120, the last price is 1.31. That means this strike price 120 with the expiration day of October 16, 2020 was last traded at 1.31. Again, don't get confused. You're like, Cody, you get paid $1.31. What are we doing here, right? Just a quick reminder is that every option contract controls 100 shares of the stocks. So when you pay 1.31, you're controlling 100 shares. So you're actually paying $131. And in reverse, if you're selling option, you're not just getting paid 1.31, you're getting paid 1.31 times by the 100. So that's $131. And number 6 is the underlying, which is the AAPL, right? That's the ticker for Apple. So all these option chain, all the pricing is based on the Apple stocks. That's what we call the underlying. The next important concept is called volatility. This is another feature that distinguishes stock option investing or trading with stock investing. Volatility is not very important in stock investing, at least not on a daily basis. In stock investing, volatility just means that how fast does the stock goes up or down, right? But an option is very, very important, and it has everything to do with your premium, whether you're paying it or you're getting paid. So let's get right into it. So overall, the volatility in stock option is the level of uncertainty in the market. The index called VIX, VIX, measures the overall market uncertainty. So the higher the VIX, that means the overall market is in a fearful mode. The lower the VIX, that means the market is in a very peaceful mode. So the average VIX value for the last 30 years is between 16 to 20. So usually if it's above 20, that means the market is in a bit of a fearful mode. And during COVID, it went as high as 80, and that's probably as fearful as you can get. The second thing is implied volatility. I will show you again on the screen. So implied volatility on the same screenshots is called IV. Is showing 47.5%. And implied volatility measures the uncertainty for this particular stock, not the overall market like the VIX, but only the particular stocks. And events that can increase the implied volatility are such as Apple earning days, or Apple stock splitting days, or the Apple new iPhone announcement day. So anything that can create uncertainty will increase the implied volatility for that expiration date. So why do I spend so much time explaining the volatility? It's because the higher the volatility, usually the buyer of the option will have to pay more of a premium to get into this lottery ticket. Now, as an option seller, the higher the volatility, that means the more premium or the more cash or the more premium you will receive as an option seller. So I'll do a quick demo on how does the implied volatility really change around Apple earning day. So let's look at my screen here, right? So I took this screenshot on October 16th, right? So as you can see, that on that day, because it's towards the end of the day, there's not much of an uncertainty that can happen. So the implied volatility was showing 13.4%. Now, on the next week, which is October 23rd, 2020, because Apple's earning day is on October 29th. So the expiration day does not cross October 29th yet. It's only a week away. So the implied volatility start increasing. So the implied volatility is showing 37.1%. Now if you look at October 30th, which is one day after the Apple earning day on October 29th, you can see that the implied volatility has drastically increased to 46.9%. So you can see that when it's towards the end of the day, the implied volatility is only 13.4%. A week before the Apple's earnings is at 37.1%, and the day after the earning is at 46.9%. So if you're buying option, you will pay the most amount of money when the IV is the highest, and you will get paid the most amount of money when you're an option seller if you decide to sell options on right after the earning date. So now that we learned all the new terminology that you need to start trading option on top of stock investing, we're going to introduce the last two most important Greeks that you need to know. Really the only two Greeks that you need to know to start as a beginner in trading options. And these two are delta and theta. So the first thing is the delta. Delta expresses the ratio change between the underlying stocks and the option price. For example, if the delta is a 0.5, that means if the stock price goes up by $1, the option price will goes up by $0.5. And also let's look at my screen now. Delta can also be a positive or a negative value, right? So in this case, you can see for Apple, October 16, 121 put option, just for example, the option price is 0.95. The delta value is negative 76.11. That means that if Apple stock price moved by $1, this option price will increase a negative value of 0.76. So there's 100 times difference in that. And also it's worth noticing that because this is a put option, and put options, delta is usually negative. And on the other hand, if it's a call option, the delta will always be positive, just something to keep in mind. And let's give you a quick example here. So in this case, we're looking at Apple's put option expiring October 16, 2020. At that time, the price for this option is at 0.95. So when the underlying stock is above $121, every $1 Apple stock price movement, the option price will move around 0.76.9, right? So if stock price goes up by $1, the option price will also go up by 0.76. Now, if the underlying stop price is below 121, which is below our strike price for this option contract, every $1 movement in the Apple stop price, the option price will also move $1. So if the stop price is below the strike price, there's a 1-to-1 movement ratio. And the second most important Greeks that you need to know to start trading option is called theta. Theta is also called time decay. Theta is the time for the position to move in your favor. Every day that passes, this theta will decrease. So for example, if you're the option buyer, whether it's a buy and call option or buy and put option, every day that goes by, that theta value is how much you are losing in the chance of the position moving in your favor. Now, on the other hand, if you're option seller, the theta value is the value that the money is putting in your pocket every day that pass by. And now I will put theta into action by showing you guys a chart where the vertical axis is the amount of option price and the horizontal axis is according to time. And I'll show you guys why sometimes you want the longer expiration date and why sometimes you want a shorter expiration date. So let's get right into it. So on the vertical axis is called the option value, which is the option price. And on the horizontal axis is the time remaining until expiration date. So as you can see, line over here is the value of theta. And you can probably see that as you know, at this point, we're around 120 days, 90 days, 60 days, 30 days, and 0 days. As we get closer to 0 days, you start seeing the slope, which is the angle of the curve, start getting steeper, right? So what does that mean? That means that the theta value is getting bigger. So if you are buying option and you are closer, your expiration day is within the 30 days, that means every day that goes by, you're paying a lot of theta. So it's very expensive for you to buy a short-term option. Right? Now, if you're an option seller, on the other hand, if you sell an option within 0 to 30 days, that's where you keep a lot of money in your pocket. So that's where you get the most benefit from it, right? So if we look at the overall chart, we start seeing from 120 days to 90 days, you see a small drop in the option value. But from the 90 days to 60 days, you start seeing a bigger drop in the value of option price. And from the 60 days to 30 days, a bigger drop comparing to the 90 days. And then from the 30 days to the 0 days, this is where theta decayed the most. This is where, as an option buyer, you pay the most amount of money. And on the contrary, if you're an option seller, this is where you keep the most amount of money, which is 30 days going into expiration date. So the summary is that time decays faster as the option gets closer to the expiration date. And the time decay the fastest within the 30 days until expiration. This graph is very, very important, whether you're an option buyer or option seller. This is the picture you should take a screenshot, print it out, and put it on your wall if you're trading options at all. So I know it's a very heavy video where we talk about a lot of terminology and 2 Greeks. But trust me, it's very, very important for you to understand these before you start trading options. Now, I did make a very comprehensive 1-hour webinar to teach beginners like yourself who are watching this video. So click the link in the description. And thanks for watching. I'm happy to be part of your journey to financial freedom. Say yay.